Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Donald Trump's brand on Wall Street, once tarnished by the U.S. Capitol attack and his bombastic political rhetoric, has made a near full recovery. It's evidenced by the lineup of bank industry chieftains attending an event earlier today with the former president. And then after that, just moments ago, we did hear from the former president at the NRSC, the National Republican Senatorial Committee on Capitol Hill. For more on that, we head to our D.C. News Bureau, where we find Bloomberg News senior national political correspondent Nancy Cook. Nancy, the names on this list: J.P. Morgan Chase's Jamie Dimon, Citigroup's Jane Fraser, Brian Moynihan of Bank of America, Tim Cook of Apple. Who was there? How long was the meeting? What went down? What do we know?
So Trump spoke to the Business Roundtable. They have a quarterly meeting, and they invited both former President Trump and President Biden. President Biden is in Italy, as you were just talking about, so he sent his chief of staff, Jeff Zients, and then Trump came. They both spoke this morning. The conversation with Trump was really a fireside chat with his former National Economic Director, Larry Kudlow. It was very friendly and did not make news, but the big thing was that he basically spoke in front of 100 CEOs, some of whom you've already mentioned, also the heads of Cisco, American Express, NASDAQ. There were a ton of real powerful CEOs in the room. And, this is pretty key for Trump as he tries to really line up a bunch of support from Wall Street and the business community, both politically, but also to help fund his campaign.
Nancy, just the visual, we have it up right now, looking at the event earlier, and in terms of Trump, meeting, just the visual significance of, or just knowing that former President Donald Trump is meeting with the likes of someone like Jamie Dimon, who, as you know, if there's a story, Jamie does something or says something, it's among the most read on the Bloomberg. We're going to talk about it a lot. These are a who's who of Wall Street, the business sector. The visual significance that is happening is this: should we read this as investors, as individuals, as voters, that this is just business as usual? I mean, the business community will meet with all political candidates.
They are, but I think it's a real recognition. The business community and Wall Street really turned away from Trump following January 6th and that attempted insurrection. And I think a number of Wall Street people in particular were flirting with backing other candidates during the Republican primary, like Nikki Haley or Florida Governor Ron DeSantis. Trump really swept those early contests in New Hampshire, Iowa, Nevada, South Carolina, and really solidified his support very quickly among Republican primary voters. And I think establishment, Wall Street, business community people are really now just seeing, well, he's going to be the nominee. They have questions about Biden's record, and a bunch of them are back to backing Trump, or they're at least open to it because they feel like there's a 50-50 shot that he could be president, and they don't want to be caught out in the cold if he is.
And to be fair, my understanding is White House Chief of Staff saw and spoke to the group earlier in the day, right? Obviously, Joe Biden couldn't because he's at the G7, but my understanding is that the White House also saw or met with the Business Council as well.
I said that already. He spoke at 9
did.
a.m. Jeff Zients, the White House Chief of Staff, talked early in the morning. President Biden was invited, but obviously he's in Italy at the G7, and last week was in France. So he's had his own really packed schedule. And so both men were invited, and, but it was just a really key chance for Trump to appear before a bunch of CEOs. And they have, the Trump campaign has been very eager to sort of put him in the position of sort of meeting with CEOs and visually looking like he has the backing of CEOs, the oil and gas industry. He's increasingly getting some support from Silicon Valley, and they're very eager to showcase that.
How would you, Nancy, explain I don't really want to call it a reversal yet, because it's not like we've seen widespread embracing of the former president at this point, but I think it does speak volumes that so many of these folks who did denounce what happened on January 6th end up in the same room as him a little earlier today. Not to mention the folks who have come out and said, yes, we didn't support him post January 6th, but we are fully on board with the former president right now. How would you explain that reversal?
Well, I think two things are happening. One, I think that in the Republican Party, there has been a wholesale rewriting of what happened on January 6th. And it's been something that's been really interesting to watch as a reporter. I think that Republican primary voters were the first people to sort of rewrite what happened, but I'm hearing from, wealthy Republicans, donors, folks on Wall Street, that what happened on January 6th was not that bad. It was not an attempted insurrection. It was more like a mob. These are people that are really, trying to cast what happened on the Capitol and people trying to overturn the election as a whole different thing, just to justify their support for, the former president. And then secondly, I think that there's a bunch of people in the business community who feel like the Biden White House has not done a sufficient job of reaching out to them. They want lower taxes. They want less regulation. And even though privately they may still have some reservations about Trump, they're willing to give him a second chance just because they feel disenchanted with Biden. And I think that's where the business community is at this point, or a lot of people are.
Well, the race is on right now. We're focusing on a lot of fundraising efforts. That's to come right next, Nancy, and that we'll be watching quickly, in the future, and that'll give us an idea of kind of how things are laying out in terms of the money that starts to come in on both sides.
That's right. We're expecting the next Federal Election Commission reports to come out a week from today. I can tell you that since Trump's conviction in New York in the hush money trial, he was found guilty on 34 counts, including falsifying business records. The campaign has raised $15 million, and it will be interesting to see next week if he has closed that fundraising gap with President Biden, who does have his own deep well of support in Hollywood, in tech, on Wall Street. But the money race is also getting tighter.
All right. Absolutely. All right. Great stuff. Thank you so much. We know a busy day for you, but really appreciate that we could check in with you on this. A lot going on, obviously, in the nation's capital. Nancy Cook, she's senior national political correspondent at Bloomberg News. She's joining us again from our Washington, D.C. bureau.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
When we look at the markets generally, we've talked about small cap stocks. They have way underperformed large cap names this year. Little change on the year, in fact, as the S&P 500 continues to take out one record high after another, it seems. The S&P 500 now is up about 14%, Tim, year to date.
Well, with a view on small business and the lending world, we have back with us Frank Sorrentino, chairman and CEO at ConnectOne Bank. It's the publicly held New Jersey-based community bank. They've got a $677 million market cap. He joins us from Long Island. Frank, good to have you back with us. That Fed decision yesterday kept rates unchanged as expected. Do you believe the Fed is behind the curve, in your view?
Well, good to be back, Tim and Carol. Thanks for having me. You said the magic words. This was very much expected. I don't think the Fed is behind the curve. I've always said that the Fed is data dependent. And I think I said a year ago on this program that the economy is robust, and it appears that happens to be true. So I think the Fed is doing exactly what they should be doing, watching what's happening. They are seeing signs of inflation beginning to come down. However, employment is incredibly strong. Small businesses have a high degree of optimism. Business is strong in many, many segments. And so those who were predicting 3 or 4 rate cuts earlier this year, I don't know what data they were looking at to make those predictions. My prediction has been rates would stay generally where they are through this year, through the end of this year.
Well, it's interesting. And, we went back and listened to our last interview with you. I think it was back in February. And you reminded us that, listen, the year before, or in 2023, late 2023, you were giving this outlook of being robust, and you said how everybody was like, you're crazy, and you've stayed upbeat. You've confirmed it again. I mean, here we are in mid-June. Everybody's still confident, still upbeat. I mean, you work with home builders, you work with, the construction folks, the manufacturers. Everybody is in a good place.
Look, I think again we need to talk about it in different segments and or different parts of the economy. But if we just want to stick with interest rates for a moment, I have been saying for the last year, and what I believe is true is if you look at historically over the last, you pick a time frame, 10, 20, 30 years, this is not a high interest rate environment. It is a higher interest rate environment than what we came from. And so when you think about a 4.25% 10-year, and you think about even the 5.25 or so overnight rate, these are not extraordinarily high interest rates. So it is natural that businesses that came out of COVID, businesses that had supply chain interrupted, a housing shortage across this country where we just can't build enough houses or apartments, that we wouldn't have a more robust economy. All the infrastructure spending that's going into the economy, all the climate issues, the military spending. You just think about everything that's happening at this moment in time, and to think that we'd have anything less than a robust economy, I just don't know where you would be getting that data from.
Hopefully we will come back to you very, very soon. Frank Sorrentino, Chairman and CEO at ConnectOne Bank, joining us from Long Island, New York.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session, getting ready to wrap up on this Thursday, June 13th, but do not go anywhere. We will head over to our TV colleagues shortly to talk about the trade. Charlie giving you all the numbers, but interesting day. Another softer, easing, if you will, inflationary print. We've seen yields move down. We've had a successful strong demand around a 30-year auction. So interesting kind of 24 hours just coming off of that Fed meeting.
I mean, the Fed meeting was big. The CPI
yesterday.
print yesterday morning, I would say, was bigger.
Huge.
Let's see what Greg Halter has to say about it. He's Director of Research at Carnegie Investment Counsel. They've got about $4 billion in assets under management. Greg joins us from Cleveland, Ohio. Greg, how are you?
Good, very good, and thanks for having me again.
Good to hear. Good to have you back on the program. Hey, interested in sort of your day two perspective of everything that happened yesterday, because it was kind of like a Super Bowl. I think Molly Smith called it for on our economics team for us here with the CPI data and then the Fed press conference. What's your day two on that?
It's a good way to put it, although it seems like every meeting the Fed has is another Super Bowl, or at least it seems that way. But now that we've had a chance to settle down, you look at some of these trends, and of course, one print does not make a trend, but some things are certainly moving in the right direction. Seems like the inflation figures are cooling, things like auto insurance, on the housing, the rent side, also, that's interesting as well. New car sales, I think, have been down for 5 months in a row, so that could lead to lower prices. So from that standpoint, at least the print that's out there, it's looking much more positive, and of course, yields are moving the way you would expect them to move.
Having said that, we've seen a lot of volatility, right? Rates moving around. The Fed reminds us, we all know, we're still data dependent. We're not quite there yet. We know that. So do you believe that when it comes to where rates are right now, I mean, we've seen a dramatic move in the 10-year in the last 24 hours. We're looking at 424 right now. We're looking at a 2-year note, 469, but I'm looking at the longer end in particular. But it's interesting. And yet, I'm not quite sure. Do you think we've topped out with rates? How do you read it?
Again, a good question. It's always funny where, we say, or at a critical juncture. It seems like we're always at a critical juncture. But it does seem like 5% seems to be a upward line of demarcation. It does not seem we'll pierce that again, at least in the near term. Maybe even 4.75 or 4.5 is too high. Again, taken in with a grain of salt, we did go from 0 up to 5. So are we going back to 0 again? I sure don't think so.
Well, having said that, as our Charlie Pellet said, we're on track if we see gains in the NASDAQ and the S&P, another day of record closes. Having said that, a headline crossed the Bloomberg. Money market assets hit a record of $6.12 trillion in the week to June 12th.
It's amazing to see that.
Right. So record closes on the equity side, and yet investors continuing to throw, their money into basically cash.
Or maybe that's just
investments.
the interest accruing in the money market accounts that it keeps bringing it higher.
Well, Greg, what does it mean?
Well, we, or at least I, don't think that money goes into the market. It's going to stay in money market funds.
Ever. Yeah.
Wait. Well, maybe not ever, but look at the long-term trend.
Yeah.
There's always been money in money market funds.
Even when rates are not 5% in those money market funds?
Look at the numbers. They've been high. Obviously, they've gone up over the last 3 or 4 years, but here's another stat. There's like $3 trillion in demand deposits earning 0. How is that even possible? How is that possible?
So what is? Yeah,
that's pretty amazing.
Well, yeah, it's right.
How is that possible?
Which means, is that pretty typical historically that we just like to have our money kind of easy, really easy access, or what? Or are we just kind of all stupid financially?
Well, I think that number has gone from like 1 to 3 trillion in the last 4 years.
Okay.
A lot of that money obviously got pumped in and it went into saving demand deposits, and people just, maybe they don't know that, hey, I can get 5% just by calling and saying, hey, switch me over to a money market fund.
I think inertia is a powerful force. I think sometimes these deposits are not as sticky as they used to be because you can pull up your smart. I mean, look, we saw what happened with SVB and First Republic, but I think it's, it's simple to pull up your phone and get it into a money market account. I don't understand why people don't do that.
Well, you say that, but I'm on the board of an HOA, and trying to move the money from 0.01 to 5% is next to impossible.
Because why?
The banks do not make it easy.
I'm going to say that I actually inquired in a bank about doing something. They don't make it easy. They don't make it easy.
I feel like the upstart banks, the fintechs, make it pretty easy, but that's an entirely different discussion.
Yeah, the establishment does not make it easy. All right, Greg, you are a stocks guy, and you are so kind to share with us tickers because Tim and I like to talk names. GPC, Genuine Parts Company, it's up shy of 2%. You've got a 2.8% gross yield on a dividend. Why is it that you think, are we going to now spend more time kind of repairing? I've been repairing a car. Repairing cars rather than buying new ones?
Well, I think the story there is this for Genuine Parts is they're actually rolling up the entities that use the Napa name but are not part of GPC. And this is like 60% of their business. The other 40% is industrial distribution, which is not all bad. It's actually a higher margin business than the auto parts business. So we've got two things going on here. Very good balance sheet, very good cash flow. I think they've raised the dividend for something like 60 years in a row. So you've got a good record there. It has been somewhat of a struggle in the auto parts business. If you look at the other entities, at least stock price wise, they've kind of pulled off their highs. But on a valuation basis, we still think GPC is attractively priced.
Okay, before we let you go, can you give us 30 seconds on chocolate? Hershey's, hurt by higher cocoa costs. It's flat for the year, really, underperforming the major indices. Why are you bullish on it?
Yeah, Hershey is interesting. They're hedged out for 2024. The issue is 2025. You thought you'd see a drop in cocoa. It went from 2012 back down to 6. Well, guess what? We're back up to 11,000 again. So, Hershey's may have some issues next year in terms of their costs. Can they raise prices? And will people continue to buy?
All right, we can't leave without asking you, how's the knee going? We just got about 15 seconds.
Hip, actually.
Oh, hip.
Great
Forgive
memory.
me. I meant hip. Yeah.
But got in my first 100-mile ride on Sunday and did 64 after work yesterday, so not bad.
That
well
is great
done.
to hear.
Well done. Well, we hope the recovery continues in your favor. Nice to get some time with you. Greg Halter, Director of Research at Carnegie Investment Counsel, $4 billion in assets under management there in Cleveland, Ohio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.